Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
I'm doing great. Thank you for having me on, Ross.
Yeah, great to talk to you. A lot of action in the bond market lately, big moves in the 10-year Treasury. We saw a big spike after a better than expected jobs report, and then it comes back down following a somewhat cooler inflation report. I wanted to just get your take on the kind of round trip we've taken in the 10 years so far in 2025, what it's looking at, what it is most important to the movement in the bond market right now, and where you think this ultimately shakes out over the course of 2025.
Yeah, it's a great question. And obviously, folks are looking at not just the drop in yields that we've seen over the last, we'll say, week, but really the jump in yields that we've seen over the last 2.5 months. And what we think is happening here is the primary driver of this reversal lower. And by the way, 10-year yields have reversed about 25 basis points lower since the middle of last week. But the primary driver, we believe, was just simply those slightly cooler than expected inflation numbers that came out last week. That's probably the biggest driver. But on top of that, you're seeing a little bit less concern about tariffs, but we have no idea how much longer that's going to last because that's obviously an evolving case. But for now, it seems to be that now that the inauguration has passed and the president has begun to implement his strategies, you're seeing a little bit of a pullback of anxiety on the tariff front. So we think those are the two biggest drivers of the push lower in yields over the last week up to this point.
Yeah, it does seem like a lot of the volatility around the uncertainty from a policy perspective is playing out in the bond market as opposed to the equity market so much. So looking at the 10-year Treasury or so, it's still in that 4.5 to 5% range on a given day. That's still pretty attractive. On the flip side, we have high yield and corporate credit spreads, which is what they're yielding above the Treasury at historically tight levels. Do you see really any value in corporate credit, either investment grade or high yield at this point?
Well, we see tremendous value in investment grade credit, even with spreads at what we would be almost multi-decade lows. Now, have only reached these levels of investment grade spreads on maybe 3 or 4 occasions over the last 20 years. So this is fairly rare to be here. But yet at the same time, we do find value here. And primary reason is that, one, I should say two reasons. One is that we believe the U.S. economy is going to remain strong in 2025. So a recession is still not something that we think is on the horizon just yet. But two, there's a lot less leverage in the system, in particular for the buyers of investment grade credit today than there was in the past. And that poses slightly less risk than we might have seen in the past as well, because simply put, buyers are not as likely to be forced to liquidate on demand. So you put those two together and we think we can hold these levels of credit spreads, but we really think it's going to be hard for credit spreads to really contract or push much lower from here. Holding these levels is probably doable for the remainder of the first half of the year.
That makes a lot of sense. I want to end here, and there's a lot going on, so at risk of bringing up another potential headwind or one that's been talked about as a headwind. But you wrote towards the end of last year about the commercial real estate market. It was a big concern post-COVID and as interest rates rose. You wrote that you've seen some stabilization, but that we're not kind of out of the woods yet. Could you give kind of your 30,000 foot view on how the commercial real estate market looks from the lens of a bond investor?
Yeah, the way we think about this is that this is probably going to be a long-term drag on bank earnings, as well as real estate investment trust earnings for the next few years. That's probably the base case scenario. And there's really, in my opinion, nothing to be outrageously concerned about if that's what happens. The risk becomes if interest rates move higher rapidly, particularly interest rates in the 5 to 10 year portion of the curve. That's when you can start to get some cross asset high correlation between commercial real estate, treasuries, and banks, and even into the municipal market as well. And so that's when we start to get concerned. We don't know the level of the 10-year treasury that would trigger this type of cross asset contagion. We also don't know how fast we have to go to get there, but it's safe to assume that some level of 10-year treasury or 5-year treasury move to at a very rapid clip could trigger an unwind that could get sloppy. For now, it appears that level is not 4.5% on 10s, and it very likely isn't even 5% on 10s. So it's probably somewhere above 5%, and as of right now, we're a good ways away from that. But if we were to see the US Treasury curve steepen with the 5, 7, 10-year portion of the curve moving higher rapidly, then we'd start to get concerned again that some of this commercial real estate risk that we believe can be kind of scooped and tossed and dealt with over the next few years, then it becomes more of a front and center problem that lenders in particular have to deal with. We're not there at this point in time. And by the way, that's not our base case that this is going to happen in 2025 or 2026, but nonetheless, it's a risk that's on the horizon.
Yeah, something to keep an eye on for sure. We obviously know that a quick spike in yields can really pressure those loans of various types. We saw that with some of the banking issues a couple of years ago. So, Tom, thank you so much for the time today. We'll be sure to check in with you again soon, but appreciate it as always.
My pleasure. Thank you, Ross.